There's a metal that's about to become more valuable than most people realize, not because of speculation, not because of hype, because the world is running out of it, and almost nobody is paying attention. In 2024, global silver demand hit 1.2 billion ounces. Global silver production was 830 million ounces. That's a deficit of 370 million ounces, the largest supply deficit in recorded history. And it's not a one-year anomaly. Silver has been in deficit for 3 consecutive years: 2022, 2023, 2024. Each year, the world consumed more silver than it produced, and the gap is widening. Here's what that means. Every year, we're drawing down existing stockpiles to meet demand, and those stockpiles aren't infinite. They're depleting, fast. The silver that's being consumed isn't going into jewelry or coins that can be melted down and recycled. It's going into solar panels, electronics, electric vehicles, and industrial applications, where it's used in such small quantities that recycling isn't economically viable. Once that silver is used, it's gone, permanently removed from the supply chain. And demand is accelerating. Solar panel installations are projected to double by 2030. Electric vehicle production is ramping up globally. 5G infrastructure requires silver. AI data centers require silver. Every major technological trend of the next decade requires more silver than the previous decade. But production isn't increasing. In fact, it's declining. Major silver mines are depleting. New discoveries are rare, and the lead time to bring a new mine online is 10 to 15 years. This is a supply crisis, and it's happening right now. But the price doesn't reflect it yet. Silver is trading around $30 per ounce. Historically cheap relative to gold, historically cheap relative to its industrial demand. The disconnect between supply fundamentals and price is the largest it's been in 50 years. And when the market finally wakes up to the reality of the supply deficit, the price adjustment will be violent and fast. This is the story of why silver is in crisis, why almost nobody is talking about it, and why the window to position yourself before the price explodes is closing rapidly. Before we get into the supply crisis, you need to understand what makes silver unique, because it's not just a precious metal, it's an industrial metal. And that dual nature is what's creating the crisis. Gold is primarily a monetary metal. About 50% of gold demand comes from investment and central bank purchases. Another 45% goes into jewelry. Only 5% is used industrially. If gold becomes too expensive, industrial users can substitute other materials. The industrial demand for gold is elastic. It can adjust. Silver is different. About 50% of silver demand is industrial, and much of that demand is inelastic. You can't substitute silver in many applications because its properties are unique. Silver is the most conductive metal on Earth, better than copper, better than gold. If you need maximum electrical conductivity in a small space, you use silver. There's no substitute. Silver is the most reflective metal. Solar panels use silver because it reflects sunlight with maximum efficiency. No other material works as well. Silver has antibacterial properties. It's used in medical devices, water purification, and food packaging. Again, no substitute. And here's the critical point. In most industrial applications, silver is used in tiny quantities. A solar panel might contain 20 grams of silver. An electric vehicle might contain 25 to 50 grams. A smartphone contains less than a gram. The amount is so small that even if silver prices doubled or tripled, it wouldn't significantly impact the cost of the final product. A $30,000 electric vehicle isn't going to become unaffordable because the silver content went from $50 to $150. This means industrial demand for silver is price inelastic. Manufacturers will keep buying silver even if the price rises dramatically, because they have no choice. The technology requires it. And that's what makes the supply crisis so dangerous. Demand isn't going to decrease when prices rise. It's going to keep increasing. Because the technological trends driving demand, solar energy, electric vehicles, 5G, AI, are accelerating regardless of silver prices. Now let's look at the supply side, and this is where the crisis becomes undeniable. Global silver production peaked in 2016 at 900 million ounces. Since then, it's been declining. In 2024, production was 830 million ounces. That's a 70 million ounce decline in 8 years. Why is production declining? 3 reasons. First, the easy silver has already been mined. The high-grade deposits that were economically viable at lower silver prices are mostly depleted. What's left are lower-grade deposits that require more energy, more processing, and more capital to extract the same amount of silver. Second, most silver isn't mined from primary silver mines. About 70% of silver production comes as a byproduct of mining other metals: zinc, lead, copper, gold. When you mine those metals, you get silver as a secondary product. But if the primary metal becomes less profitable to mine, the entire operation shuts down, and the silver production stops too. Even if silver prices are high, if zinc prices are low, the mine closes and the silver byproduct disappears. This makes silver supply highly dependent on the economics of other metals, and right now, many base metal mines are struggling with high energy costs, regulatory pressures, and declining ore grades. Third, there are almost no new major silver discoveries. Exploration has been underfunded for years because silver prices were too low to justify the investment. And even if a major deposit is discovered today, it takes 10 to 15 years to bring a mine online. Permitting, environmental studies, infrastructure development, capital raising, it's a long process, so production is declining. And there's no quick way to increase it. Even if silver prices doubled tomorrow, it wouldn't bring new supply online for a decade. Now let's look at demand, and this is where the crisis accelerates. In 2000, global silver demand was 850 million ounces. In 2024, it was 1.2 billion ounces. That's a 40% increase in 24 years, and the growth is accelerating. Solar panel demand for silver has increased 10 times since 2010. In 2010, solar panels used 50 million ounces of silver. In 2024, they used 200 million ounces. And solar installations are projected to double by 2030. If that happens, solar demand alone could reach 400 million ounces annually. That's nearly half of current total production. Electric vehicles are another massive demand driver. A traditional internal combustion engine car uses about 15 grams of silver. An electric vehicle uses 25 to 50 grams. Some high-end EVs use up to 100 grams. Global EV production in 2024 was about 14 million vehicles. That's roughly 350 to 700 million grams of silver, or 11 to 22 million ounces. But EV production is projected to reach 40 million vehicles annually by 2030. That would require 30 to 60 million ounces of silver per year just for EVs. Triple current demand from this sector alone. Then there's 5G infrastructure. Every 5G cell tower requires silver for its circuitry and antennas. There are currently about 5 million 5G base stations globally. That number is projected to reach 15 million by 2030. Each base station uses roughly 1 to 2 kilograms of silver. That's 15 to 30 million ounces of silver just for 5G infrastructure over the next 5 years. Add in AI data centers, which require massive amounts of silver for their electrical systems and cooling infrastructure. Add in medical devices, which increasingly use silver for its antibacterial properties. Add in traditional industrial uses like electronics, batteries, and chemical catalysts. The demand is exploding. And it's all inelastic demand. These industries need silver. They can't substitute. They can't reduce usage without sacrificing performance. So we have declining production and accelerating demand. The deficit in 2024 was 370 million ounces. If current trends continue, the deficit could reach 500 million ounces by 2027. Where is that deficit being filled from? Existing stockpiles, government reserves, private inventories, recycled silver from old jewelry and coins. But those stockpiles are finite, and they're depleting rapidly. The U.S. government used to hold 6 billion ounces of silver in strategic reserves. By 2024, that's down to effectively zero. It's been sold off over decades. The COMEX, the major commodities exchange where silver futures are traded, holds about 300 million ounces in registered inventory. That's silver that's available for delivery against futures contracts. At the current deficit rate of 370 million ounces per year, the entire COMEX inventory would be depleted in less than a year if industrial users started demanding physical delivery instead of rolling over paper contracts. This is the crisis. The world is consuming more silver than it produces. The deficit is being filled by drawing down stockpiles, and those stockpiles are running out. When they're gone, there's no buffer. Supply and demand will have to balance through price, and the only way to balance is for price to rise high enough to either reduce demand or incentivize new production. But as we've established, demand is inelastic, and new production takes a decade to come online. So the price will have to rise, a lot, and fast. If you're starting to see that silver isn't just another commodity but a critical resource in a supply crisis that almost nobody is paying attention to, then you need to understand what happens when the market finally wakes up. Because when it does, the price won't rise gradually, it will spike violently. Subscribe to Economy Time Machine right now, because in the next few videos, I'm going to show you exactly how to position yourself in silver before the supply crisis becomes undeniable. Hit that subscribe button. Now let's talk about why the price doesn't reflect the supply crisis yet. Because if the fundamentals are this clear, why is silver still trading at $30? The answer is paper silver. Futures contracts, ETFs, derivatives. Financial instruments that represent silver but aren't backed by physical metal on a one-to-one basis. The COMEX silver futures market trades hundreds of millions of ounces of silver every day. But the actual physical silver available for delivery is only 300 million ounces. This means the paper market is massively larger than the physical market, and the price is set in the paper market, not the physical market. When an industrial user needs silver, they don't buy futures contracts, they buy physical metal. But when investors want exposure to silver, they often buy ETFs or futures. They don't take delivery of physical metal. This creates a disconnect. The paper market can suppress prices through leverage and speculation, even when the physical market is in severe deficit. But this disconnect can't last forever. At some point, industrial users will demand physical delivery, and when they do, the paper market will be exposed as a fractional reserve system. If even 10% of paper silver holders demanded physical delivery, the system would collapse. There isn't enough physical silver to back the paper claims. This is what happened in 2011. Silver spiked from $18 to $49 in a matter of months. Not because of a supply crisis, but because investors started demanding physical metal and the paper market couldn't deliver. The exchanges raised margin requirements to crush the rally. They changed the rules to prevent a squeeze, and the price collapsed back down. But the supply situation today is far worse than 2011. Back then, there were still government stockpiles. There were still large private inventories. The deficit wasn't structural. Today, the deficit is structural. It's not going away. And the stockpiles are nearly depleted. When the next squeeze happens, and it will, the exchanges won't be able to stop it by raising margin requirements, because the physical shortage will be real. Industrial users will be competing for limited supply, and they'll pay whatever it takes to secure the metal they need for production. Let me show you what this could look like based on historical precedents. In 1980, silver hit $50 per ounce. Adjusted for inflation, that's $185 in today's dollars. And that spike happened without a structural supply deficit. It was driven purely by investment demand from the Hunt brothers trying to corner the market. In 2011, silver hit $49. That was driven by investment demand following the 2008 financial crisis. Investors were fleeing paper assets and buying physical metals. Both of those spikes were temporary. They were driven by speculation and investment demand, not by fundamental supply shortages. And both times, the price crashed back down when the speculative fever broke. But the current situation is different. This isn't speculation. This is a real physical supply deficit that's getting worse every year. If silver were to reach its inflation-adjusted 1980 high of $185, that would be a 6 times increase from current prices. But that assumes the supply deficit doesn't get worse. If demand continues accelerating and production continues declining, the price could go much higher. Some analysts are projecting silver could reach $100 to $150 per ounce by 2030 based purely on supply and demand fundamentals. Not speculation, not investment mania, just industrial users bidding up the price to secure the supply they need. And if investment demand kicks in on top of industrial demand, if investors realize that silver is in a structural deficit and start buying physical metal, the price could spike even higher. $200, $300, potentially more. This isn't hype. This is what happens when you have inelastic demand, declining supply, and depleting stockpiles. The price has to rise to balance the market. Now let's talk about what this means for you. Because understanding the crisis is one thing. Positioning yourself to benefit from it is another. Physical silver is the obvious play. Coins, bars, anything you can hold. When the supply crisis becomes undeniable, physical silver will trade at a premium to paper silver. You want to own the real thing, not a paper claim. But there's a problem. Premiums on physical silver are already elevated. In 2024, you're paying $3 to $5 over spot price for silver coins. That's a 10 to 15% premium. If you buy at $30 and the premium is $5, you're really paying $35. The price has to rise above $35 just for you to break even. This is the cost of owning physical, but it's worth it. Because when the squeeze happens, when industrial users are scrambling for supply, physical silver will be worth far more than paper silver. Silver mining stocks are another option. If silver prices rise, mining companies will see their profits explode. A company producing silver at $20 per ounce and selling at $30 makes $10 profit per ounce. If the price goes to $60, they're making $40 per ounce. That's a 4 times increase in profit margins. But mining stocks are leveraged bets. They're more volatile than the metal itself, and they carry operational risks. Mines can flood, equipment can break, governments can change regulations. You're not just betting on silver prices. You're betting on the company's ability to execute. Silver ETFs like SLV are the easiest way to get exposure, but they come with risks. SLV is supposed to be backed by physical silver, but the fine print allows for all kinds of exceptions. And in a real supply crisis, there's no guarantee you'll be able to redeem your shares for physical metal. The safest play is physical silver. The highest upside play is mining stocks. The easiest play is ETFs. Ideally, you'd have a mix of all three. But the key is to act before the crisis becomes obvious. Because once the mainstream media starts reporting on the silver supply deficit, once industrial users start publicly competing for supply, the price will already be spiking. Right now, in early 2025, silver is still cheap. It's trading at historically low ratios relative to gold. It's trading below the cost of production for many miners, and it's trading as if the supply deficit doesn't exist. This is the window, the time when the fundamentals are clear but the market hasn't priced them in yet. This is when fortunes are made, not by chasing prices after they've already spiked, but by positioning before the spike happens. The silver supply crisis is real, it's structural, it's accelerating, and it's not going away. Production is declining, demand is exploding, stockpiles are depleting, and the paper market that's been suppressing prices is going to break when physical shortages become undeniable. The price will have to rise, not gradually, violently, because that's what happens when inelastic demand meets constrained supply. The question isn't whether silver will spike. It's whether you'll be positioned before it does. The pattern is clear. Silver is in the largest supply deficit in history, 370 million ounces in 2024 and growing. Production is declining. Demand is accelerating from solar, EVs, 5G, and AI. Stockpiles are nearly depleted, and the paper market that's been suppressing prices can't hold much longer. When the physical shortage becomes undeniable, the price will spike violently, and the window to position yourself at current prices is closing. If you want to understand exactly how to position yourself in silver, which forms to buy, which miners to watch, and what the warning signs are that the squeeze is beginning, then subscribe to Economy Time Machine right now. Because the supply crisis isn't hiding in some distant future. It's happening right now, and the market is going to wake up to it soon. Subscribe now, and I'll show you exactly how to play it. I'll see you in the next one.